Keith, I'm going to start off with you. Just give me a sense. How do you see today shaping up? Obviously, we have quote unquote Liberation Day or the Tariff Day coming up on Wednesday. Do you believe all the tariffs and the risk there, is that priced into the market, or are we going to see more volatility going forward?
I don't think it's all priced in. As you know, Frank, we downgraded equities back in February when there was a lot of complacency in the market. I think there's just a lot of uncertainty related not only to the tariffs, but really to the slowdown we're seeing in the economy. And also what you alluded to earlier in the show is on technology as well. So listen, we could see a relief rally when we get the news. I just think that this market on a short-term basis, as we look over the next couple of months, just has some work to do, some choppiness. And I think it's going to be very difficult to get back to new highs anytime soon.
So, Kevin, similar question for you. I'm looking at the VIX. The VIX at about 24. Is that a concerning level? Do you see, the quote-unquote fearing gauge moving higher from here? What is your expectation when it comes to volatility?
Volatility has been so muted, Frank, for seemingly years that when we see it jump up above 20, we start to get a little concerned. And I think that we should expect volatility to continue. I'm not expecting Wednesday to be a complete resolution where we've got a clear path to the future regarding tariffs. To Keith's point, I think we can see volatility continue, maybe not just for the next few weeks, but possibly for the next few years. So as a covered call seller, seeing the VIX at 24 isn't a scary thing. It gives us something to do. But yes, as an investor, I would expect volatility to continue for the foreseeable future.
Also as an investor, when you hear the news from that Goldman note that they're seeing the number of Fed cuts this year, Kevin, I'm talking to you, by the way, see the number of Fed cuts go from 2 up to 3 this year. What does that tell you just about, the sentiment when it comes to the markets right now, also the sentiment when it comes to the economy?
Yeah, I'm not sure I'm in that camp of 3 cuts, but I love how you've covered sentiment throughout the whole show, Frank, not just consumer sentiment, but also investor sentiment. And usually it's something that we can kind of shrug off a little bit, but I'm worried that there's a chance for a self-fulfilling prophecy, at least with the consumer sentiment, because even though the data remains good in retail sales, you made a point earlier that it's backward looking. If the U.S. consumer tightens their belt, they're concerned about tariffs, they stop spending, that's a problem because it's going to be reflected in growth, it's going to be reflected in earnings. And that's the fear that I have. So I think we have to pay attention to sentiment a lot more than we perhaps have in the past.
Keith, coming back over to you. We had Bill Lee from Milken on earlier. He said, I'm paraphrasing, by the way, this isn't exactly what he said, but he basically said those surveys don't always accurately portray the real situation right now. But I'm going back to that University of Michigan survey. 5-year outlook for inflation at 4.1%, highest read since 1993. That's a long time ago. What does that say to you, not only about consumer sentiment, but also investor sentiment? Investors often look at these numbers as well.
Yeah, well, one caveat, Frank, is if you look below the surface and those sentiment surveys, they're somewhat polluted because there's a big difference between political affiliation on those surveys. So if you look at it, you're seeing, Republicans expecting inflation to be almost like 1%, and you're seeing Democrats expect inflation to be almost 4 or 5%. So I would just keep that in mind. But more importantly, if you look at the GDP estimates, something's changing right now. We're seeing GDP estimate cuts for the first time in several years. And at this point, S&P forward earning estimates continue to move higher. We think there's downside risk to those earnings moving forward because of that GDP slowdown, and also because of profit margins dealing with tariffs as well. So again, with market valuations somewhat elevated and you have earnings now at risk, we just think that the upside is likely going to be capped. One caveat, Frank, when you see 10% pullbacks a year later, you have a positive skew. I just think the next few months is going to be somewhat more challenging.
All right, so I think it's going to be more challenging. So let's get to the top sector that you're looking at right now is utilities. That's kind of a safety trade. Is that a dividend play right now, or do you actually think that the equities themselves are going to move higher in this environment?
It's a relative play, Frank. I think they're going to hold up better on a relative basis because of what you said. They tend to be more stable, less economic sensitive. They're not being really impacted by the tariffs as much. They have a 3% dividend relative to about 1.4 for the S&P, and they're trading at about a 12% discount to the overall market, while relative price trends are moving higher. So in an environment where there's going to be somewhat, continued periods of choppiness, we think this is a good relative play, at least to hide out for the time being.
All right, Kevin, I want to come over to your pick. It's Meta. So I know you're mainly focused on being a dividend investor. Obviously, Meta does have a dividend, a relatively small one. I do want to ask you, are you concerned that if we're going to see an economic slowdown, that their primary business, which is ads, is going to slow down as well?
Yeah, absolutely, Frank. I'm very concerned about that. But our base of our portfolio, like Keith mentioned, is in great dividend-paying stocks, low beta. So when we see a stock like Meta that's come down 23% from its mid-February highs, To your point, it pays a modest dividend, just gave a fractional dividend bump recently. They've been buying back shares for 3 years. PE ratios are getting closer to 20. Could this go down another 10, 15, 20% on ad revenue declines? Yeah, I think it could. But as far as trying to time a stock like this, we're taking a position in it here, adding to it. And if it pulls back, nothing to be scared of. We'll add to it further. Chart looks a little ugly. So could you get it cheaper? Yes, perhaps. But if you get a surprise on Wednesday where the tariffs aren't that bad and you get a little bit of a relief rally, even if it's only temporary, you can look back on this opportunity and be happy that you at least put a little bit of money to work on the more speculative side. We think this is a nice name within the Mag 7 space.
All right, Keith and Kevin, we're almost out of time. I want to ask you very quickly about bonds. Keith, you go first. We're seeing yields actually decline on concerns about economic growth. Are bonds attractive right here? And if so, what part?
Yeah, bonds are acting like bonds again. So we do think within a portfolio context, they will act as a hedge for the stock market volatility. And we would keep it simple with high quality fixed income. Keep it simple.
Kevin, same question for you. I know this is in your wheelhouse, but seeing any opportunities in bonds?
No, just buy dividend paying stocks. Who needs bonds?